Trade a quick look at the Asian markets. Remember, the US markets did not do too well yesterday as there were fears of a deeper recession or deepening of the inversion of the yield curve. But despite that, the Asian markets, they are trading in positive terrain, and that's something that we can witness on the Nikkei higher by about 0.1%. Not much change in the currency out there. The investors definitely are closely monitoring the yields following an overnight inversion, but the Korean markets, again, you have about 0.75% gain seen out there. The Straits as well as the Taiwanese indices should come up for you. The Taiwanese index really outperforming in these two indices, among these two indices. And the SGX Nifty, after a near 500-point rally over the last 3 trading sessions, the indications are that it would be a positive start. So weakness on Wall Street not translating itself into the Asian markets or the Indian market so far. So let's see where it goes from here.
Okay, so that was the action from Asia. Now, investor sentiment has been cautious following a recent escalation in the ongoing trade war between Beijing and Washington. Meanwhile, the editor-in-chief of Chinese state-run newspaper, The Global Times, said in a tweet yesterday that China is not putting so much emphasis on the trade talks and that it is becoming more and more difficult for Washington to press Beijing to make concessions. But what do experts make of these developments? Here's some opinion.
It's not good for emerging markets, at least in the short term, because there's a lot of adjustments to be made. And particularly in Asia, because you must remember that most of the Asian nations have their major trade partner is China. So this creates some problems. But as you just heard, there are some countries that will benefit from the movement of manufacturing from China into these other countries. So we have to balance out and look very carefully at who's going to benefit and who's going to be hurt. But generally speaking, it's not been good for the emerging markets.
I think the Chinese government now has a feeling that they can manage those pressures. Certainly, so far, the capital account management has worked well, and we haven't seen those pressures develop. But I think the Chinese will use this tool very sparingly to send a political signal to Washington, because at one level, it isn't going to be enough to fully offset the effects of the tariffs, and it comes with some risks. But certainly now they feel comfortable, I think, in terms of allowing some yuan depreciation to partially offset the tariffs and send a message that they're going to use every measure at their disposal to strike back against the U.S.
His opinion on the US-China trade tensions, but let's also take a look at how Wall Street fared now yesterday. Stocks closed lower in an overnight session, reversing the morning gains as hopes of a resolution of the US-China trade war began to fade. Additionally, bond yields slid and the US Treasury yield curve inverted further, signaling some more concern about global economic growth. Now, the Dow Jones fell around 120 odd points at close. The S&P 500 and the Nasdaq both dropped around 0.3%. The spread between the 10-year and the 2-year rate also fell to -5 basis points. Remember, this is its lowest level since 2007. We now have CNBC's Eric Chemi to get us a wrap of everything that transpired on Wall Street.
U.S. stocks finishing the day lower. The Dow off 121, the S&P losing 9, and the Nasdaq down 27. Purdue Pharma reportedly offering between $10 and $12 billion to settle more than 2,000 opioid claims, according to NBC News. The settlement comes from lawsuits brought on by states, cities, and counties, all alleging that the company's sales practices were deceptive and partly responsible for starting and sustaining the opioid crisis in America. Just yesterday, Johnson & Johnson was ordered by an Oklahoma judge to pay $572 million for its role in the opioid epidemic in that state. Meanwhile, bank stocks sliding lower today. The dip in financials coming as the spread between the 10-year Treasury yield and the 2-year rate fell to its lowest level since 2007, and as yields on 30-year bonds fell below 2%. And the Department of Justice announcing a criminal indictment against former Google engineer Anthony Levandowski. The DOJ charging that Levandowski took confidential information from Google's self-driving car project Waymo. The charges allege he used that information to launch his own self-driving car company that was later acquired by Uber.
All right, so that was about Wall Street. On that note, let's also hear out some opinion coming in from market experts on the Fed's rate trajectory and the global markets going ahead.
The Fed has to deal with the economy they have, but it's clear You know, the fact that the president increased tariffs the day after the last Fed cut does suggest that if he gets easier monetary policy, he feels that's licensed to be tougher on trade policy. I'm not sure that's a recipe that's going to work very well for the economy. This is really much more a matter of business confidence and consumer confidence. I mean, the consumer confidence numbers sound very good, but I think the problem with business confidence is not so much confidence as uncertainty. And I think this back and forth in the trade war is causing business uncertainty.
I think the tail risk has grown. I think you have to be concerned about policy is a concern, global growth is a concern, manufacturing is a concern. By the way, I'm not concerned about the consumer. I know there's a bunch of discussion about the consumer. I think consumer's in great shape. Savings is up, income is up there. The optimism is actually very high. So yes, I think you got to be concerned about tail risk. The demand for yield is extraordinary. We live in a global marketplace. You look at what European rates are doing today. You get this amazing pull into U.S. rates that, quite frankly, I think is going to keep going. There's not enough yield. There are not enough bonds in the world, and I think it is going to continue to drive what is pretty extraordinary dynamic.
I think it has to matter as part of what's pulling down longer-term interest rates here in the U.S. and thinking about what that means in the future for policy easing. There's no question that starting with now the federal funds rate just above 2%, if the Fed needed to ease aggressively like in past easing cycles, there's just less room for them to cut rates. With interest rates being as low as they are now, a decent chunk of the accommodation in financial markets that would come is already there. So they do have less space to go at this point.
Positive on the U.S., very, very cautious on emerging markets, particularly if you look at the action in the U.S. dollar most recently. Positive U.S. dollar has never been good for emerging market returns, and that's clearly the environment that we're walking into. So if we continue into an area of global uncertainty, significant shifts in geopolitics, the flight to quality, the flight away from risk, which is generally a flight away from emerging market assets, favors the U.S. dollar over EM.
All right, and across the Atlantic, European markets, all of them ended mostly higher after China's State Council announced relaxing auto restrictions, as a result of which the German index gained about 0.6%. The UK market underperformed to end marginally in the red, and that's primarily because it was playing some bit of catch-up. It was shut in the previous trading session. As for the data that came by, the German GDP, that showed the economy contracted on weaker exports in the second quarter as trade disputes and waning foreign demand continued to weigh, particularly on the auto sector.
Let's take a look at the currency space now. The dollar index manages to hold steady against the major currencies. Now, while the euro stabilized after coming under pressure following data showing Germany was on the brink of a recession, the pound also held on to gains as opposition politicians stepped up efforts to prevent a no-deal Brexit.
In the world of commodities, crude oil prices inch up with the Brent trading near $60 per barrel. Crude extended gains on expectations of shrinking U.S. inventories.
Okay, it's time for us to slip into a quick break now, but stay tuned. We'll get you all the cues and news you need to know for trade this morning.